So hello, good afternoon, and thank you for joining our webinar today on driving liquidity with supply chain finance. My name is Gary Cuttress and I'm the Sales Director at SureComp Business Systems. It's our mission to provide innovative trade and supply chain finance solutions hosted either on the cloud as trade finance as a service, as well as on-premise installations for corporates and banks around the world. It's my privilege to be your host for today's proceedings, which will explore why supply chain finance has become such a pertinent topic in recent months, particularly in the context of banks using it as a tool to help live liquidity and improving customer engagement amidst these troubled times. We also look at how technology can help add value to the supply chain finance process and why it's key in the context of driving customer loyalty and retention. So just before I introduce our speakers, I must let you know that this session is being recorded and we will be sharing the link afterwards for any of your colleagues that were not able to attend. Also, perhaps you can replay more pertinent aspects of it at a later date. So to our speakers then, and let me first introduce Yanis Malios. Yanis is the Banking Solutions Director at Profile Software, and we are collaborating with Profile for this webinar as they are one of our key strategic international partners. Profile helps banks address their technology needs in many areas across corporate and transaction banking, wealth and risk management. Based in Greece, Profile works with banks across many parts of Southern and Central Europe, as well as the UK, the US and the Middle East. Our other speaker today is Andrew Coles. Andrew is a seasoned trade and supply chain finance expert. He recently joined SureComp as the head of global solution consultancy. Andrew's career has been built around trade and supply chain finance and has for many years experience working with banks to help address their business needs. He has held delivery, solutions, consulting and pre-sales roles covering the US and Europe, the Middle East and most recently Asia Pacific, and he's now with SureComp based in London. So with those introductions complete and a busy and packed agenda, it's my pleasure now to pass over to Yanis to lead today's session. Yanis?
Thank you very much, Gary. Really appreciate the introduction. I'm Ioannis Malios, Banking Solutions Director for Profile Software, a Greek international company. We are also very happy to have this webinar today and host Andrew and discuss about SureComp's offering in the region. As you mentioned, SureComp is a strategic partner for Profile, and we are looking forward to develop the solutions and to add value to our customers. So nothing more to say from my side. Thank you very much, and looking forward for a fruitful and very valuable to our guest webinar.
Thank you, Gary. Thank you, Yanis. And thank you all for joining and for spending some time with us today. I'd like to start by taking a quick look at the current state of the supply chain finance market. And in particular, I've got some figures here from a recently published report. Now, for the purpose of clarity, when we're referring to supply chain finance, we're talking predominantly about the arrangement whereby a supplier's invoices are approved by a large buyer for financing, by a bank or a financier. The term supply chain finance can be used in more general terms, but specifically for today, we're talking about approved payable financing or reverse factoring or some of the other names they're known as, but really these kind of buyer-anchored programs around approving invoices. Now, as we can see from these high-level numbers, the market for supply chain finance has grown significantly since 2019. And that's despite of the pandemic and the other factors that are affecting us, such as ongoing US-China tensions and the uncertainty around the impact of Brexit, for instance. In fact, I think most of these factors have played a large part in fueling the growth of supply chain finance in this last year, as corporates and many companies are looking to banks and alternative forms of financing in order to secure their supply chains and to really weather the storm and to get through these troubling times. Globally, volumes have grown by about 35% since 2019 to a total of $1.31 trillion US dollars. That's aligned with a 42% growth in funds use across the same period. Now, this growth in itself is spectacular considering the period for which it's recorded, but it's very much following a trend that we've seen in this market. This market has actually quadrupled in size since 2015, and it's actually showing no signs of slowing down. If I can take a bit of a deeper look into a regional breakdown, we can see that Americas is still dominating the market, recording the strongest growth of any region at 37%, taking their total volumes to about $726 billion. Now, although this figure actually includes Latin America and Canada, we can assume that most of this growth has come from within the United States. Asia and Europe actually continue to follow very similar growth trajectories, with 35 and 31% growth respectively. Interesting though, Asia has shown a funds in use growth of 70%, up to 69 billion, compared to about 38% for Europe. So it seems as though there's a lot more borrowing against those facilities happening in Asia. And finally through to Africa. Now, although the market size is much smaller, their growth is in line with global averages at 34%. So all in all, very positive year for supply chain finance, despite, as we mentioned, these kind of macroeconomic factors that are really impacting global economies. And it's some of those factors that I want to look at and discuss in a bit more detail. Now, I would say that, as with most things, the pandemic has really exasperated or accelerated many factors. COVID-19, one of the impacts and one of the results of this has been a drive towards regionalization and away from globalization. Companies are looking to onshore or nearshore their supply chains, and there's been a shift in the location of production sites. In fact, one prediction estimates that about 25% of global trade might change borders. Now, this presents significant challenges to banks and will really stretch their agility to be able to support their customers as they shift and move their supply chains. The value of intermediate goods has increased threefold in recent years. Now, with that increase, there's come an increased complexity around how supply chains are created. They can be crossing the world multiple times, and they've usually been optimized for efficiency and cost. However, one thing that's been discovered through this crisis is that these supply chains are not very resilient, and there's a lack of transparency, which is causing huge amounts of risk. The impact of a large buyer, for instance, cancelling or delaying a contract, can be devastating as that flows down the supply chain. I believe it's referred to as the bullwhip effect. Most companies or corporates really only see the tip of the iceberg, and some of these supply chains can be deeper and can upwards of 10 layers in them, with very, very little visibility the further down they go. There's key challenges that still remain around customer onboarding and the regulatory burden and KYC. This is very important when we think about the need to be able to onboard the long tail of suppliers and to be able to push that financing further down the supply chain. A number of these processes are still very paper-based, and they require, in some cases, face-to-face verification. And again, because of the pandemic, this process is now an impossibility. KYC and onboarding processes can sometimes take weeks or months. And this can lead to clients abandoning that program set up with that bank and moving to a different bank that can offer them a more agile and rapid onboarding, as they need themselves to be agile to meet the rapidly changing environment. Different levels of sophistication among suppliers is also a challenge. Larger corporates, and they may well have well-developed IT environments and sophisticated system of records, whereas the smaller companies, they'll still be working on Excel or using paper. Now, again, this is something that has been accelerated as a result of the pandemic, where everybody's been forced into remote working environments, and the need for digitization has become higher and higher up the priorities. So there is a drive towards digitization of a lot of these processes in smaller organizations, but there is still much more work to be done. Aside from the technology and the legal aspects, the actual provision of receivables finance is generally not very difficult. The challenge that a supply chain finance funder, be it a bank or a separate funder, they really face issues in getting visibility further down the supply chain and offering finance earlier in that cycle. There's significant risk that you will take on by offering financing to these suppliers. So there's a definite need to be able to perform quick onboarding, but also very quick credit decisioning. And again, and access to the data to support that is often an issue. And finally, and perhaps most important for banks, and not just from supply chain finance, from our experience, but really it's about understanding the requirements of your customers when defining a supply chain finance program. Far too often there seems to be a focus on products and not on tailored solutions that really meet the customer's needs. It's very important to build those strong relationships with customers and offer a real combination of products and services that are tailored to solve real problems for these corporates. And this really goes beyond the bank's customer and further down the supplier network. How do you get the entire supply base on board? I mean, quite often the challenge is not the paperwork so much, it's around the people work. How do you demystify the complexity and really explain the benefits of supply chain finance products to these smaller enterprises? And just thinking about these suppliers for a moment, I wanted to look just briefly at one relatively new but very interesting topic in this space, ESG. Now, ESG stands for environmental social governance. And this has been a really interesting development over recent years about how banks and large corporate buyers are leveraging supply chain finance programs to incentivize sustainable behavior in their global supply chains. It's become so important, in fact, that quite recently, Santander stated that an ESG strategic option is a must-have for all new large programs. Now, the benefits of a well-established ESG governance framework to manage risks in company supply chains is widely recognized. And many companies have programs in place to assess and manage human rights, labor governance, environmental, and other kind of risk factors on their suppliers. However, despite best efforts, these issues are still pervasive. There's been numerous high-profile news stories about factories collapsing in Bangladesh, for instance, or workers' rights in the production factories of certain major retailers that have terrible impact on them, not just from a reputational risk perspective, but also from a sales perspective. Now, there's ESG-led SCF programs. What they do is they add a financial incentive for the suppliers to improve their own ESG standards by utilizing a third-party rating agency to assess a supplier based on a set of criteria. Now, they could assign them an absolute score. It could be a comparative score against their peers. It could be a score against a set of goals defined by the buyer. And the goal of this is, as they request financing, that score will be used to provide financial incentives, better pricing segmentation, or rebates, for instance, at the end of the year. Good ESG performance is rewarded with better financing conditions. Now, from a corporate perspective, the benefits are obvious. It improves the overall standards. But from a bank's perspective as well, this offers an opportunity to go deeper into understanding the client supply network. Again, giving them the ability to offer tailored financing products and really tailor and create a supply chain finance program that really meets their needs. And this can then be used to flow further down the supply chain. So as these first and second tier suppliers start to improve their own ESG standards, that will then flow down to their network of suppliers, increasing visibility and mitigating risk all the way down. So how do we look at some of these challenges and how do we address these? Well, naturally, we at Surecom and Profile, we see the benefits that technology can bring. And the continued drive towards digitalization has been accelerated by some of the factors I've mentioned. Well, it's something that we welcome. On that topic of digitization, there have been countless conversations about the role that new technologies will play in revolutionizing the trade industry, with blockchain or distributed ledger technology perhaps the most heralded. However, more than any other advance in technology, open banking seems to be showing the most promise for achieving full digitization of supply chain finance flows and really improving the customer journeys. Here I'm thinking about the ability to plug directly into the accounting software or the ERP system of suppliers in order to provide seamless customer journeys and really embed financial services directly into that procurement workflow. The use of cloud computing resources and artificial intelligence allows for huge amounts of data to be processed and can help solve some of these problems around risk mitigation, credit decisioning, even spotting invoice dilution. OCR can be used to extract data from documents to help on the KYC process. And we even have companies working on blockchain-based digital identities, again, to be able to share these KYC data and provide a trusted source and proof of ownership. Now, that being said, we can't ignore these blockchain platforms, be it a logistics or an invoicing platform, a financing solution or a marketplace, for instance. However, interoperability, I believe, is going to be of key importance for these solutions as they mature. What we also seen is a large number of banks have been investing in their own connectivity and expanding their own platforms. And they've become much better at working with the broader fintech ecosystem to specify or to meet specific customer journeys. Now, this type of agility is key, we believe, to the success as these supply chains become more fluid and as they shift not only geographically, but also as customer interactions become more increasingly digital. One thing that we must ask ourselves as an industry when defining digital solutions is, are we really solving a challenge that the industry is facing? And if so, what are the real pain points the solution is addressing? Often we see technically feasible solutions that meet viable business cases, but unfortunately, the human desirability aspect is sometimes missing or forgotten. At the end of the day, it has to be about providing services that the customers actually want and putting their needs at the forefront. Customer expectations are increasingly sophisticated. The new generation of corporate treasurer is expecting the same digital, seamless experience in their financial services as they would with all their other daily interactions, from buying a coffee to ordering groceries online to managing their own personal finances. For banks to remain relevant to these customers, to retain their business and to attract new customers, they must provide them with these digital experiences that not only meet, but really kind of exceed their expectations. And finally, it's not just all about what we can do, but it's also about what the government initiatives and the regulatory bodies can do. And really, here we're seeing some great advances in the industry where we see governments collaborating and working with the banks and with the corporates to drive forward an agenda. One great example of this is the TREAD system that was rolled out by the Reserve Bank of India. And now this had the goal of facilitating financing for micro and small, medium enterprises. And to ensure adoption, the government mandated that all buyers above a certain size would be onboarded and had to provide access to their approved supplier invoices. In addition to ease the KYC and onboarding, they standardized the KYC process and shared the data amongst the multiple funders and the lenders on the platform. They even went so far as to create a central repository to prevent double financing of invoices and reduce any kind of fraud. And this model we see being followed by other countries in the region. Thailand, for instance, is looking to roll out a very similar platform where they're using additional features such as risk mitigation and credit insurance capabilities to add more value to the platform they provide. So very much we see government initiatives really driving the industry forward approach. So collaboration with regulators as well as the broader fintech ecosystem can really bring great advances in the field of supply chain finance. So just really to summarize some of the points. Trade flows are becoming increasingly fluid as they react to these major market forces. And banks are looking now how they can support their customers to secure their supply chain using supply chain finance products more than ever. The continued drive to digitization has not only increased, but it's taken on a new urgency now as a result of this pandemic. And now that we realize what's possible with regards to digitization and remote working and the lack of dependence on paper, for instance, we really do need to continue this momentum and push this digital agenda forward, not just within banks and the finances, but also with regards to government mandates and government regulations. Banks and financiers who are able to provide real solutions that meet their customers' needs are well placed to thrive. However, there are still substantial barriers, specifically around the onboarding and the KYC regulations. But we are seeing a drive towards modernization, and we're seeing great advances in all these areas. So it's with that I would like to hand back to you, Yanis. I believe you've received some questions.
Thank you very much, Andrew, and I really appreciate and thank you for the presentation. Yes, indeed, we do have some topics that are challenging and needed to be discussed, and I would like your input this one. So starting from the numbers that you mentioned at the beginning, that the supply chain finance has grown for more than 1 trillion USD. And also in general, as profile, we are seeing that this is a continued shift from traditional instruments like LCs to trading over open accounts. So how do you combine this one? How can Surecom support this trend? And of course, how our clients can leverage of this 1 trillion market?
Yeah, so that's a great question. If we look at the global trends in trade, LC business, it used to be the dominant instrument, with open account being much smaller. The volume of LC traffic, I guess, is much less now, maybe 10–15% of global trade, but the value of LC business is still very high. And that's because it is an invaluable risk mitigation instrument. Yes, it's cumbersome. Yes, it's burdensome. Yes, there's lots of paper involved. And the cost of it is often a reason why people are moved towards open account. That open account trading, because of the availability of data now, and because of the interconnectedness and the platforms available, there's a lot less risk involved in that. So a lot of people are establishing their trading relationships and starting over an open account. And this is really where we see the possibility for offering supply chain finance, this unfinanced area of global trade. The market at the moment for supply chain finance is very much around well-established trading relationships. So looking at these established relationships and offering financing to support that business. But with the prevalence of technology and the advancement in marketplaces and the benefits that a decentralized ledger can bring around that proof of ownership and proof of identity, I would see a lot more supply chain financing being offered as a service within these type of platforms interactions. From a bank's perspective, there is still the same requirement on how you manage those invoices, how you check that against your credit facilities, how you manage the risk associated with that. And we at Surecom provide a holistic solution that covers both traditional trade finance and working capital solutions from a single solution. Supply chain finance used to be, or is still, managed in different departments at some banks, but we've seen a market shift to bring those together to create much more of a working capital solution for their corporates. So really being able to get a 360-degree view and holistic view of that corporate's business and provide them that tailored approach. So depending on the type of business they're doing, is this the correct financial product that you need to support that business? And you can only really achieve that if you have all of that customer's data together in a single place where you can have that true view of their entire business. But yeah, very interesting question.
So we do have also questions coming from our audience, which are, let's say, interrelated. So I will just try to put together two topics. The one, as you would expect, is COVID and social distancing. So simply to put, clients are not going to the branches to support their operations. So how is Surecom ready to support social distancing and cloud and digital operations? And please let me just add something that is relevant and is coming from your presentation. If know your customer and onboarding, now that we also do not go to the branches, is a key issue, how the proposed solution is dealing with this issue. So social distancing, not going to the bank, and digital onboarding. I think that's the question.
Yeah, so, and again, it's another great question and very pertinent. This all ties in really with that drive towards digitization. It's the realization that we can't have these face-to-face verifications. We have to find digital solutions. And this is where the fintech ecosystem comes in. There is a huge amount of innovation. Probably about 90% of innovation in financial services is happening outside of banks. And key to the success has to be embracing this fintech ecosystem and bringing in point solutions to solve these bigger problems. There's a number of companies out there that are working specifically on how to achieve digital onboarding, how to achieve verification over phone, over video, for instance, and providing, and to your one point of how we support this, is we provide an API-based marketplace, which allows these fintech solutions to be plugged in to our back office processing capabilities to be able to create a full end-to-end solution across things such as KYC and onboarding, but also across the full range of journeys that you would have through this flow. That being said, this has to go hand in hand with government regulations. There has to be an acceptance, for instance, that we can accept digital documents or digital signatures or digital verifications. And so here we have this, this need. It's not just about how the technology can solve the problem, but it's about how we can have adoption of that technology or adoption of that solution within the industry. So a very interesting and very key topic.
So there is, thank you very much, Andrew. There is a question from Mr. Subik Chakraborty. I hope I don't kill the name. So the question is, how can we leverage the entire supply chain of a bank's customer, either a buyer or a supplier? And please allow me to add here, as I did before, another topic about the trade finance as a service. So not only the buyers, but also how can the banks can leverage of a software as a service solution and how you are prepared to cover this.
So again, thank you. So if I start with the software as a service, so there's been great advances in cloud, not only with the ability to be able to process and manage huge amounts of data, but also with regards to the security aspects of these cloud deployments. Cloud providers have been working very closely with governments and regulators to ensure that they provide financial grade hosting capabilities. I've seen a real shift in the market in recent years from the cloud providers away from, shall we say, consumer products and a much more focus on supporting financial industries. And so with regards to being able to deploy a mission critical system and run that from within the cloud, all issues around security, for instance, all issues around availability and resilience, they're being addressed by the cloud providers, which is a great benefit. Now, being able to bring a cloud solution online for a bank obviously reduces down cost of ownership. It provides agility to be able to incorporate new features and functionalities without costly maintenance that we would have with legacy systems. And because of the technology, it allows for that interconnectivity with other fintech solutions, which are also being deployed to run within cloud environments. Now, how can we leverage that entire supply base of the corporate? And really, when we are able to exchange data and start to get insight, it gives us the ability to move further down that long tail of suppliers. Really understand not just knowing your customer, but know your customer's customer or know your customer's customer's customer. And that can only really be achieved at scale with effective use of technology and effective use of data. Being able to offer financing further down that supply chain and being able to understand the risk implications of getting down that long tail is one of the great advances that I believe we're going to see over the coming years, as we do see more maturity around the market, but also around the technologies that are being developed to support it. I believe.
Thank you, really. Thank you, Aldo. Just to point out about the risk that you mentioned, you are talking about the secure transactions and cybersecurity threats, correct? Is my understanding correct?
Yes.
Okay. Gary, I do think that while seeing the internal chatting, I do think that you also have some topics.
Yeah, we have one final question then, gentlemen, and that's that approved payables is being used mostly by large buyers at the moment because of the need to prove they can repay. How can we encourage smaller enterprises to get involved, and what are the barriers to entry?
Oh, again, a great question. So one tool that can be used would be credit insurance, but this does actually increase cost. So again, that could be a potential barrier to entry for these smaller suppliers. But really, the only way I think is to get closer to the buyer's systems and really increase the bank's trust that they can repay. APIs, for instance, can be used to check into the sales ledger and check their repayment history. So again, back to the point around open banking and getting more access and information. If a buyer was to open up their sales ledger to a bank, then that would give banks the ability to perform much better credit decisioning and really start to offer these solutions to these smaller enterprises.
Very good, thank you.
Okay.
Well, unfortunately, we are out of time. So, ladies and gentlemen, that concludes our webinar presentation today. We trust we've highlighted some of the positive benefits that incorporating supply chain finance solution in your organisation can provide. And let me also remind you that we've recorded the session, so that can be made available for you at a later date. Also, so I've done some of these where we've had no questions from the audience, so thank you very much for your highly well articulated questions that you've posed today. So it just remains for me to thank our speakers today for their excellent presentations. Thank you both, that for thought-provoking commentary, and thank you the audience for joining. I look forward to seeing you for the next webinar series very soon. Thanks again and goodbye.
Thank you.
Thank you very much. Thank you.